Targets in Focus provides you with the latest projections from some of the world's leading banks, as well as an exclusive interview with the bank's FX strategist to give an insight to the reasons behind their forecasts. Today I'm joined from Vienna by Dr. Valentin Hofstätter, who is the head of currency research at Raiffeisen Bank in Austria. Thank you very much for talking to Dukascopy TV, Valentin. We saw some risk appetites return to the markets at the beginning of this week, which seemed to put a slight halt to the rise of the Swiss franc. Do you think that risk appetite will last? And where do you see the Euro-Swissy heading at the end of this quarter, Q3, and into the next two quarters?
We're skeptical this will hold actually, because what has been driving the Swiss euro so relentlessly lower down to parity was mostly the Eurozone problems, the debt crisis lingering on in the peripherals, even then taking over to countries like Italy. If you just follow the orchestra within European politicians, all the problems that seem now to come up again about ratification of those agreements, just mentioning enhanced measures that the EFSF is allowed to do, buying, for instance, bond on secondary markets. The ESM has to be ratified. The second package for Greece has to be ratified in many parliaments. It does not look that this will all go smoothly in September. So we actually expect a hot autumn. If the Swiss National Bank does not intervene massively, we will retest the lows at least, and we think then by the latest the Swiss National Bank will intervene, step into the market and try to stop this at parity. Of course, we don't know. We could see the Swiss National Bank already intervene at an earlier stage, 1.05, 1.010 euro Swiss franc. Point is where at whatever point the SNB, the National Bank, let's say convincingly enters the market, we think they have the means to stop this. Question is, at what level will they do it? And certainly not at current levels. We don't think they have a chance to, or the willingness to intervene at 1.16 or even at the almost 1.20 that we saw over recent days.
There were poor consumer confidence figures out this week from both the Eurozone and America, but all eyes next week will be on Obama's post-Labor Day jobs plan. How do you see this all affecting the euro-dollar, and where do you see this pair heading at the end of the quarter and looking forward to the next two?
I would say in the short term, you have two major driving factors, obviously. One is also the development of the euro debt crisis. As I said already, we are not optimistic in this respect. Don't get me wrong, we don't think the project will fall apart. The problem is just we will probably need another intensifying pressure from markets on politicians to get all these things approved and ratified that have been finalized over the summer. This would actually be a bad signal for the euro. So that's also one of the major reasons why we think towards the end of the year or the next month, euro dollar will come down, fall below 140. Our year-end target for this year for euro dollar is actually 1.35. Major reason being this negative sentiment for the further development of the Eurozone debt crisis. That this is not only not over with yet, but will again resurface and intensify before it abates again. What could, of course, cause short-term hiccups in euro-dollar is the US side, meaning if US data gets so weak that QE3, another round of quantitative easing by the Fed, becomes more and more a done deal, and data this week I think will show already very much in this respect, whether we get it or not. If markets come to the conviction you will see another massive round of quantitative easing, then in the meantime you could easily go up to 150 first before you come down.
Finally, there was similarly as disappointing economic data from the UK this week. Do you think the British economy is at risk as much as the Eurozone and the US? And where do you see the cable heading in the short, mid and long term?
UK economy, yes, is also weak. We don't see it endangered as much as the European economy, mostly because, where is the weakness in the European economy? It's still mostly in the peripheral countries, in the broadest definition, including Italy, where you have this massive first pressure from the markets, therefore high refinancing costs for the government, pressured to cut down deficits in a very short time. So tax increases, cutting government spending, this all makes pressure, of course, in the short term on the government side. On the positives, you could say, well, in Great Britain you didn't have pressure on financial markets. Spreads were not rising, yields were not rising for British government bonds, but only because they were cutting the deficit first place. So also they have a contractive fiscal policy, which is, of course, in the short term not so good for economic growth. But what we don't see in the UK is pressure from markets, which is important for the banking sector as well. If you think about, for instance, Spain, Italy, a very important potential channel from this debt crisis on growth would be that it makes the refinancing for banks difficult, expensive, and that they, of course, pass on this more difficult refinancing regime on their on the people that borrow from the banks. And this, of course, then depresses investment, etc. Therefore, it's a big plus for the UK that here you don't have this pressure from markets on the government. Yields there are extremely low, like in Germany, so they are better sheltered, I would say. Nevertheless, in a global weakening, the UK cannot escape. The domestic economy is not strong at all, and if now also the export side is weakening, as it does, also they will get very close to another round of quantitative easing. The equilibrium of bad news will be pretty even, so just swinging slightly up and down, where in the weekly flow of news sentiment is swinging, but no big shifts actually in this pair. And then heading into 2012, of course, the big question is, we think will come from the interest rate side, which central bank sees the economy fit first to start again tightening monetary policy. So far, we would expect that this is rather the UK, as the US has pretty much promised already they would not change the interest rate outlook for the next year.
Thanks very much for joining me, Valentin. That is all we have time for now, but there will be more targets in focus next week on Dukascopy TV. Goodbye.